Greetings, dear learners. My name is Mr. Simbi, and welcome to today's accounting class. In today's class, we're going to be talking post-adjustment trial balance. So what you see here is a pre-adjustment trial balance of ABC stores. And then what we want to do is to look at the adjustments, and then we're able to create a post-adjustment trial balance. Here are the adjustments. It has to do first with the land and buildings, which has been rented out, and we have the account of a debtor that must be written off, advertising paid for the month of March, so we have depreciation as well. Okay, and then we have an expense paid for repairs. Adjustment number 1 then reads, part of the building has been let to a second tenant, TT Traders, at the beginning of February at $720 per month. The rent from TT Traders for February has not yet been received. That means we are dealing with accrued income. Accrued income. In the pre-adjustment trial balance, we have rent income, 15,840 on the credit side. What we want to do is to now post the amounts that must go into the post-adjustment trial balance. The moment we have accrued income, remember, that goes to the balance sheet. So we are going to come now under the balance sheet account section, and we'll say accrued income, and it is receivable, so it will come to the debit side. It becomes 720. Under the nominal accounts section, we therefore come, then we say rent income. We had 15,840. However, there is 720 that was still to be received. So if we add those two amounts, you therefore get a total, which is 16,560, which I bring to the credit side, onto the credit side. So I've added 15,840 plus 720, which gives me 16,560. That is how you do adjustment number 1. Adjustment number 2, it reads, the balance of the account of S. Smith, a debtor, must be written off as irrecoverable. He owed the business $480. The moment an amount is to be written off as irrecoverable, that means we are talking of bad debts. Bad debts. In our pre-adjustment trial balance, we have debtors control and bad debts. In the post-adjustment, it means we come now to our debtors control, where we had 27,576. Then we say we now have 480, which is being subtracted from this amount because we will not be able to receive that amount. We are decreasing our debtors control. So we come here, then we say minus 480. We subtract the bad debts from the debtors control. That then gives us 27,096. 27,096. We have subtracted 480 from 27,576. That amount, the 480, is now part of the bad debts. That means we come here to our bad debts. We had 596 in the nominal account section. We are going to come and add 480. Our bad debts have increased because S. Smith's account has been written off. And then once we add that, we now have 1,076. Our bad debts have increased because the account of S. Smith has been written off. This is how you would do it when you have bad debts. The next one is advertising, and it reads, advertising for the month of March in the next financial period, 570, has already been paid. So we have paid advertising for the month of March. Our financial year ends in February. So we've paid an expense for the next financial period. We therefore call that a prepaid expense. We call it a prepaid expense. When we have a prepaid expense, we will come now in our post-adjustment trial balance under the balance sheet account section, and then we say prepaid expense, and the amount is 570, and we bring it to the debit side, 570. When we come to advertising, we are saying 5,460 is what was in the pre-adjustment trial balance, yet 570 for the month of March has already been paid. So we therefore come here and we decrease that 570 minus 570. That therefore gives us an amount which is 4,890. This is what remains of our advertising. And we bring it to the debit side as well because it is an expense. Adjustment number 4, it reads, depreciation on vehicles is calculated on cost price at 15% per annum and equipment at 10% on the diminishing balance method. Let us then look. Let us start first with our vehicles. You can see here our vehicles have a cost price of 70,000. So I'll come here and I'll say 70,000. And then I want now to calculate the depreciation. And it is 15% on cost. So I'll say 70,000 multiplied by 15%. Multiplied by 12 over 12 because we had it for the entire financial period. And the amount that I'll get from that calculation is going to be, if you punch in your calculator, you are saying 70,000 multiplied by 15%. You get 10,500. This is for your vehicles. That means I can come now to my depreciation and I say I have 10,500. This is for the vehicles. But I know that I also have equipment. So I must calculate depreciation for equipment. And the cost price of my equipment is 25,000. But on equipment, I'm calculating depreciation using the diminishing balance method. That means I would therefore say 25,000, which is the cost, minus accumulated depreciation, which is 20,480. That gives me a carrying value of 4,520. Then I take the 4,520, I then multiply it by 10 over 100, multiplied by 12 over 12. And this will therefore give me 452, which becomes my depreciation. I'll also come and add this to my 10.5, that is 452. And therefore, my depreciation would therefore become 10,952. 10,952. Once you have recorded your depreciation here, you can come now and also look at your accumulated depreciation. On your accumulated depreciation on vehicles, at the beginning it was 67,200. So I'm just going to put it here. I had 67,200. Now, I have more depreciation on vehicles, which is how much? 10,500. So I'm going to come and add 10,500. If I add these two amounts, I now have 77,700. That becomes my accumulated depreciation on the vehicles. I'll do the same with my equipment, where I had 20,480, 20,480, and then I'm adding the new depreciation amount, which is 452 plus 452. Then I'll have a total which is 20,952. This is how you would then do your depreciation when you are recording in the post-adjustment trial balance. The next adjustment then reads, an amount of 250 has been paid for repairs to the store, no entry has been made. In other words, we have paid for repairs to the store, but there has been no entry. We therefore come to our bank where we have a positive balance because it is on the debit, 2,984. Then we subtract because we have paid, 250. That means our bank balance therefore becomes 2,734. Our repairs, therefore, will be recorded on the debit side as an expense, 250. We do not have any repairs in the nominal account section, hence you see it blank here to say there were no repairs in the pre-adjustment trial balance. So we are recording these repairs as a new entry because they were not in the pre-adjustment trial balance. When you are done then, you will see your post-adjustment trial balance with the amounts that are adjusted. Dear learners, let's go for an ad break and I'll see you shortly.